Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So far 21 problems I have completed on financial management regarding computing the cost of capital, computation of average return, expected return. All these problems I have completed. So if you want to have a complete command on this topic of financial management, I suggest you to watch all the videos from beginning till end. Don't join in between, don't skip in between. So if you keep a rhythm of watching one after another, then only you can be able to get the complete command. So if you have not watched the earlier videos, I suggest you to go to the playlist of my channel. Select the subject financial decision making. Select the videos of this financial management. First 3 videos you watch, there I have explained you completely regarding the meaning of the term financial management. What are the techniques available in financial management? What are the issues regarding risk and return? And what are the financial instruments? And what is cost of capital, importance of cost of capital, how to compute the cost of capital. All these things I have explained in the initial videos. So now I'm going to start in this video the next problem, that is 22nd problem. So 6 more problems I'm going to explain in this video. So before starting the video, I expect my viewers to have a printout of the problems which are given in the link under my description. Always keep ready the problems. Take the screenshot of the solutions of these 6 problems, then I'll explain. Now, see the problem number 22. X Limited issued 5,013% redeemable preference shares of rupees 100 each at rupees 110. That means the shares are issued at 110. That means premium. 100 rupees face value share is issued at 110 rupees. They are redeemable after 10 years at 5% premium. At the time of redemption, the company is repaying back to the preference shareholders at 5% premium. The flotation costs are 3% of the issue price. Corporate tax rate 50%. Actually, we don't require corporate tax rate for calculating KP. Because for preference, cost of preference capital, there is nothing like before tax or after tax. Only for debentures, debt, we have to consider the tax rate. Here just ignore the corporate tax rate. Ascertain the cost of preference capital. First of all, it is a redeemable debt. When redeemable debt is there, the formula for KP is DP plus RV minus NP divided by N divided by RV plus NP divided by 2 into 100. This is the formula already we have applied in the previous problems also, right? Now, one by one we'll calculate. DP is equal to dividend on preference shares. It is given 13% of the face value. So how many shares are there? 5,000 shares of 100 each. So 5,000 into 100 is 5 lakh. So 13% of 5 lakh, 65,000 is DP, preference dividend. Now, redemption value. At the time of redemption, it is redeemed at 5% premium. So we have to add the premium. The face value of all preference share is 5 lakh plus 5% premium. So it comes to 5,25,000. At the time of redemption, the company will return back 5,25,000. Net proceeds on issue. At the time of issue, the preference shares were issued at 110 rupees each. So how many preference shares are there? 5,000. So 5,000 shares into 110. It comes to 5,50,000. Now flotation cost is given 3% on the issue price. The issue price is 5,50,000 including premium. So 3% of 5,50,000 you will get 16,500. So 5,50,000 minus 16,500. 5,33,500. This is the net proceeds on issue. Next, N is 10 years, period of redemption. Now we substitute the values in the formula to get the KP. DP, how much is the DP? 65,000. Then redemption value 5,25,000. Net proceeds 5,33,500 divided by 10. whole divided by 5,25,000 plus 533,500 divided by 2 into 100. We have substituted all the values. Now 5,25,000 minus 5,33,500, you will get negative figure. Minus 8,500 you are getting. In numerator you are getting minus 8,500 divided by 10 to 850. You will get 850, right? So 65,000 minus 850 divided by 5,29,250 into 100, 12.12%. So 12.12% is the KP. That's it. So we have completed problem number 22. Now problem number 23. Now come to problem number 23. See carefully. Calculation of cost of preference share capital. 23rd problem, first of all, we'll see what are the contents of the problem. A company issues 10,008% preference shares of rupees 100 each at a discount of 5%, redeemable at the end of the year, 10th year from the year of issue. Calculate cost of preference capital. Here, the preference shares are issued at discount. There is no flotation cost and redeemable at the face value. Redemption will be at the face value. Again, this is a problem of redeemable preference shares just like the previous problem. So calculation of cost of preference share capital, KP DP plus RV minus NP by N, RV plus NP by 2 into 100. So 8% of 10 lakh. How 10 lakh? You see carefully. 10,000 shares of 100 each. 10,000 shares of rupees 100 each. So 10 lakh. So 8% of 10 lakh, 80,000. Redemption value. Redemption value, nothing is given in the problem, so we take it as a face value. The face value is 10 lakh. The net proceeds. The preference shares are issued at a discount of 5%. So 10 lakh, 5% is 50,000. So deduct 50,000, 9 lakh 50,000 is the net proceeds. Number of years of redemption, 10 years. Now you substitute 80,000 plus RV 10 lakh minus 9 lakh 50,000 divided by 10. Then 10 lakh plus 9 lakh 50 divided by 2 into 100. So 10 lakh minus 9 lakh 50,000 is 50,000. 50,000 divided by 10 is 5,000. So 80,000 plus 5,000 divided by 10 lakh plus 950 divided by 2, 9 lakh 75,000 into 100. So 8.72 is the cost of preference capital. Over. We have completed the specific cost of debt KD and specific cost of preference KP. The last one is specific cost of equity. The next problem we'll start on equity capital. Now 24th problem. Priya Limited has rupees 5 lakh equity shares of rupees 20 each and the current market price of the share is 50 rupees. This is the first problem on equity capital, right? The company Priya Limited has 5 lakh equity shares of rupees 20 each and the current market price is 50 rupees. The profit after tax of the company is 10 lakh. Calculate the cost of equity capital on price earning method. See, calculating the specific cost of debt is very easy. Calculating the specific cost of preference is also equity because the rate of interest and rate of dividend are fixed, right? But in case of equity, the rate of dividend is not fixed. Every year the rate of dividend on equity share will change according to the profitability of the business, according to the declaration made by the directors. So it is difficult to calculate the cost of equity. There are different approaches. One approach says DP approach, dividend price approach. Second approach, dividend price plus growth approach. Third, earning price approach, realized yield approach. So different, analysts have given different methods of calculating the cost of equity. Now it depends on the problem, what information is given in the problem. Accordingly, we will apply the approach. But in this problem, specifically it is given, calculate the cost of equity according to earning price approach, specifically given in the last line. So we are going to apply EP approach. See carefully. Calculation of cost of equity capital by earning method, price earning method. So KE, K stands for cost of equity is equal to E by P into 100. This is the formula of calculating cost of equity according to earning price approach, where E is equal to earning per share. E stands for earning per share, but earning per share directly is not given in the problem. We have to find out the earnings per share. Remember the formula: profit after tax divided by number of equity shares. This will give you EPS, earnings per share. So how much is the profit after tax? 10 lakh rupees given. And number of equity shares given in the first line, 5 lakh equity shares. So 10 lakh divided by 5 lakh, you will get 2 rupees. So earnings per share 2 rupees. And P stands for market price per share. What is the market price per share given in the problem? 50 rupees, that is given in the problem. So now I substitute. Cost of equity is equal to earning per share 2 rupees, market price per share 50 rupees into 100. 4% is the cost of equity. That's all. So we have completed 24th problem. Now 25th problem. Current market price of equity of X Limited is 120 market price. Company paid 12 rupees dividend for the last year, and a constant growth rate of 8% is to be maintained in dividends. Ascertain the cost of capital. Now in the problem it is not specifying which approach we have to apply, which method we have to apply. By seeing the contents of the problem, we can decide. First of all, market price is given. Market price 120 rupees. The company paid 12 rupees as dividend last year. So we are given dividend. And growth rate in dividend is 8%. So we are given the market price, we are given the dividend, we are given the growth rate. So we can apply DP plus G approach. Dividend price plus growth approach, that will apply. But the dividend was given for the last year. Last year dividend was given, but we need the current year dividend. The current year dividend will not be same as last year. The current year dividend will grow at the rate of 8% given in the problem. You can see the dividend is growing at the rate of 8%. Last year dividend paid was 12 rupees. So don't think that last year dividend 12 rupees paid, current year also 12 rupees. No, there is an increment of 8% growth rate, right? So we calculate how much is the dividend for the current year. Calculation of cost of equity by DP plus G approach. Dividend price plus growth approach. P is equal to market price 120 rupees given. Last year dividend 12. Last year dividend. Therefore current year dividend will be D1. D1 is the symbol used for current year dividend. DO is the symbol used for last year dividend. So how to find out current year dividend D1? DO into 1 plus G. Remember the formula. D1 current year, DO last year dividend. So current year dividend is equal to last year dividend into 1 plus G, right? So 12 into 1 plus 0.08. Growth rate 8%. So 8 by 100, you will get 0.08. So 12 into 1.08, you will get 12.96. D1. So current year dividend is 12.96. Now we substitute in the formula. K is equal to D1 by P. How much is D1? 12.96. Divide by P. P is the market price, 120 rupees. So 12.96 divided by 120 into 100. You will get 10.8%. 10.8 because we have multiplied by 100. So that's why I am taking 10.8%. To this we add the growth rate. The growth rate is 8%. So 8. 10.8 plus 8, 18.8 is the cost of equity capital. The cost of equity capital is 18.8%. That's all. So this is the problem on cost of equity capital. Next one is 26th problem. The common stock of X Limited has present market value of 250. Market price 250. The company had declared a dividend of 25 rupees per share in the year just concluded. Just concluded means last year. Just like the previous problem. Last year dividend 25 rupees. Now current year dividend we have to find out. So DO is given 25. We need D1. So DO into 1 plus G. Expected growth rate in dividend is 8%. Ascertain cost of equity. Also estimate the market price if the expected growth rate is 10% per annum. So two different questions. The first question we have to ascertain the cost of equity. Second question, it is asking you to calculate the market price. So first we calculate cost of equity. See carefully. Calculation of cost of equity according to DP plus G approach because growth rate is given. KE. First of all, D1. D1 is not given. DO, last year dividend is given 25 rupees. So D1 is equal to DO into 1 plus G. Just now I told you here. We need current year dividend. In the problem, last year dividend is given. We give the symbol D1 current year dividend and DO last year dividend. So D1 is equal to DO into 1 plus G. So 25 into 1 plus 0.08, 8%, 8 by 100. So 1.08. So 27 rupees is the current year's dividend. Now we substitute. K is equal to 27. D1 divided by 250 is the market price per share given in the problem into 100. This will give you percentage. How much? 10.8%. To this we add the growth rate. The growth rate is 8% plus 8. So 18.8% is the cost of equity capital. First part completed. The second part of the problem says calculate the market price per share if the growth rate is 10%. If the growth rate increased to 10%, what is the market price per share? So again we apply the same formula. K is equal to D by P into 100 plus G. KE. Assuming the cost of equity is same as 18.8%. KE is 18.8. Already we have got it. Then D. Dividend is 27 rupees. P. Market price we have to find out. Unknown variable is P. Into 100. Plus G. Now growth rate is 10%. Growth rate is 10%. Now bring the 10 from RHS to LHS. It is plus 10. It will become minus 10. So 18.8 minus 10 is equal to 27 into 100. 2700 divided by P. So 18.8 minus 10 is 8.8 is equal to 2700 by P. Now make a cross multiplication. 8.8 P is equal to 2700. P is equal to 2700 divided by 8.8. 306.82. This is the market price per share. That's it. So we have completed 26th problem. One more problem we'll do it in this video, that is 27th problem. A company issues 10,000 equity share of 100 each at a premium of 10%. The company is issuing 100 rupees of equity share at 110 rupees, 10% premium. The company has been paying 25% dividend to equity shareholders for the past 5 years and expects to maintain the same in future also. That means there is no growth. Last 5 years the company is paying the dividend at 25% and in future also it is expecting the same 25%. No growth at all. So we apply DP approach. Dividend price approach. DP approach. Compute the cost of equity capital. Will it make any difference if the market price of the equity share is 175? So two different questions. First question, compute the cost of equity capital. See here. Computation of cost of equity. K is equal to D by P into 100. Growth rate is not given. That's why I am not applying plus G. Only D by P into 100. Dividend per share is 25% of the face value. Face value of the share is 100 rupees. So 25% of 100, 25 rupees. That is D. P. Market price per share. It is not given in the problem, but it is given that the company is issuing the shares at 10% premium. That means 100 rupees share the company is issuing at 110 rupees. 100, 10%, 10. So 100 rupees is the face value, 10% is the premium. 10% of 100 is 10. So add up, you will get 110. The company is issuing the shares in the market at 110. That means market price is 110. The present market price is 110. Now cost of equity, 25 rupees is the dividend, 110 rupees is the market price into 100, 22.72 is the KE, cost of equity at present. Now one more sentence it is asking you, will it make any difference if the market price per share becomes 175? Yes, it will change. If the market price per share is 175, earlier we have taken market price per share 110. Now substitute 125. So 25 divided by 175 into 100, 14.29% is the cost of equity if the market price is 175. If the market price is 110, it is 22.72. That's all. So this is the end of 27th problem. So far, I have explained 25 problems on various topics of this financial management subject. In this 27 problems, first few problems are on calculating the returns and the remaining problems are on specific cost of capital. So we have computed how to calculate cost of debt, how to calculate cost of preference, and now calculating the cost of equity. Inshallah, we'll continue the next problem in the next video.